Hey folks, I think we've got this together. Thank you guys all for joining me today. One thing I want to say at the beginning of this video is please smash that light bulb, smash that thumbs up if you have a light bulb moment, and don't forget to subscribe with the little bell because that'll let you know when I come in unannounced. Yes, I am showing up on time today, but on the daily market commentaries or spotting the trade videos that I do every day, well, those are going to be hit or miss at the timing of that video. It's usually in the early morning, so check your times there, but it's usually around probably 9 o'clock Eastern. So that's about when I'm going to shoot on. But again, it's still somewhat unannounced. All right, this is going to be cracking the code, your options guide to trading. And we're going to be talking about building from a simple concept to real life examples throughout this video. And by the end of it, I think that you folks will have a moment where you absolutely can see the wheels turning in your favor and be able to adjust accordingly with your trading regimen. All right, so without further ado, let's get on with it. I think I got the screen showing finally without messing that one up. Let me slide over here just a little bit so I can get situated for the rest of the video. All right, here we go. This is going to be a video on the long put butterfly. And before we get to that, before we even talk about that, because the long put butterfly breaks a lot of rules that we've talked about in the past. So I'm going to go through this and as to why it comes out as a long put butterfly, but really the design around this is to create an environment around a short with defined risk. But it ends up being a long because of the debit that we create with this strategy, at least the way that I'm building it out. All right, folks, you've probably seen this if you've watched the video already, but what this is kind of representative of is that options montage page. That's where all the puts, calls, all of those numbers are flashing back and forth, and it can be a little intimidating. I'm not going to lie. When you're looking at this and trying to keep up with it, you're trying to count the O's and ones. Well, this is the most streamlined way to transfer data. So while that seems like a heavy lift, let's just pause it for a moment, strip back this onion a little bit, look into the layers and see how the mechanics work here. What we can see is that the O's and ones aren't consistent. It's O, 1, 1, O, 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 things like that. So when you're a programmer, you can look at this and immediately understand what's going on. Same thing with us as trading options. We look into that option montage page and at first it can be very intimidating. You know, there's a lot of things going on there. And if you don't understand it, you might shy away from it. And as a matter of fact, if you don't understand it, you're going to make mistakes like I've talked about quite often in some of the previous videos and even in spotting the trades. I'm not going to throw anybody in particular under the bus, but I will throw those examples out there as to what I've seen and how that is just going to be like pushing a rock up a hill. It's a Sisyphean effort. So first, when we're going to talk about trading, investing, stuff like that, we'll get to the option strategy here in a moment, but I want to specifically get your mind thinking about price and investing and how you can be a good steward of your capital, right? That's the most important thing, especially in a time like this. I mean, we've been talking about these dead cat bounces and things like that in the markets, when to take advantage of certain moves, because we are in a pretty bearish trend right now. Yeah, some folks were trying to say we were breaking out of it, but if you watch those spot the videos, you've been seeing what I've shown how, well, yeah, we have created a higher high possibly, but that doesn't necessarily mean that the technicals are turning into a bull market right now. But before I get into that, anybody throw it out there. If you guys want to comment throughout this video, we are also on Facebook. You can comment there as well. But what I want to hear from you folks is, what do you think is the most common best investment that someone will give you? Or if you ask for investment advice, what is usually the best investment advice you get? From my understanding, or from what I hear a lot of times from you folks and from even me, what folks ask, a lot of times what I hear coming back is the best investment you can make is in a house. But has anybody watched housing prices lately? Well, lately it's been pretty easy. They've been pretty parabolic almost to the upside. especially if you've moved out of rural areas like New York, Chicago, and moved into a different state, you've probably done very well. But one of the things that we've seen going on is, even if we just roll back to the .com, we actually saw some housing prices even dip a little bit during the .com as folks were trying to raise capital, right? Selling their house, best investment. But then we saw another rebound happening. And then right around 2008, we took another little dip, a little rebound. 2011, it took another even stronger dip on the market, or on the housing market prices, right? So while we could look at it like, hey, it's a great investment, 2008 happened. Well, even during the pandemic, we saw, right before the pandemic, we even saw a nice little downtick in housing markets. So while you always think that you're buying high and selling low, it isn't always that case, because during that time, you might have been buying a house low thinking you were doing pretty good, but then the next crisis came along, right? Well, what is happening right now? We're talking about interest rates rising. And if you know what happens when interest rates rising, it causes housing prices to go down. And the product of that really is the fact that we are all on a budget, right? It doesn't really matter how much money you're making. You're still on a budget. You can't just go and buy whatever you want, and maybe unless you're Elon Musk or something. But you and I, folks, who are on this world, usually have a budget. And what we do is we take a percentage of our income and allocate that towards a home, right? Well, when interest rates rise, that interest rate money is something you still have to pay for. So if you could only afford, let's say, $1,500 for a mortgage, or $1,000 for a mortgage, to make math easy, if you can only afford $1,000, well, when interest rates rise, you can still only afford $1,000, but that means that more of the principal, or more of the payment you're making, is going to the interest rather than just the principal. When we had lower interest rates, it was basically all going to the principal. So while we can still only afford the same amount for our allocation to our residence, that was a little, I was going to say a different word, but if we can only afford that much, then that means housing prices are going to correct a little bit, because we can't afford that much of a house. And if all of us are struggling to afford it, housing prices are going to have to come down a little bit. I don't know how far down. I mean, I've heard people talking that this recession could almost be as bad as the .com that I just talked about, where we saw housing prices, stock market falling down. All right. Are we in that paradigm? If we continue to see higher prices for things that like crude oil, for instance, then yes, we could definitely see something like this correct. So while it seems like a very easy concept that we buy low and sell high, we don't always know, like this chart, where it's going when we first get in. For instance, back there at that buy low, sell high, the obvious thing to do right now is to give you the obvious thing to do when you're looking at a chart is, yeah, you just buy and sell and then buy and sell, right? I mean, it's so easy that anybody could do it when you're looking at a chart like this, right? Well, it's not always quite that easy at all, to be, as a matter of fact. Usually what happens is we think we got the buy low, maybe you got the rally up, missed the IPO or something like that. IPO, you're thinking, oh man, I need to get into this trade. So you get in a little bit late and you buy it. Takes a little bit dip. Well, you didn't buy the high, but not yet. Now it rallies. You might wait for it because it looks like it's going to continue. If you're looking from this point, and all of this is X'd out, right? That looks like a pretty good trade, but it drops right back down to where you were, and maybe even drops again. Well, what would happen when it drops down to the IPO price or goes below that? Well, you're going to panic and you're going to want to sell. And that's not so easy, right? It's not just as easy as buying low and selling high, unless you were in an underlying that trades sideways like this, right? If we were able to trade something like this, then we could look at the chart and say, hey, folks, we've got a bit of a line in the sand here we can draw to give us some support and resistances. And Usually market neutral or sideways trending underlyings are the easiest ones to trade. A great one to start out with if you're trading options or just trading in general. And I'll tell you that it is easier to see a trend going sideways rather than a bullish or a bearish move. It's just easier to follow that sideways move. Kind of like our eyes want to see smiles or faces in toast or whatever it is. Well, the same thing goes here is we line things up horizontally, and that is indicative of a sideways market. So we can kind of pick it and then say, all right, now you start selling up here, and then you would be wanting to buy when it comes down to that support level, right? That makes it a little bit easier when we can see a trend and understand that a trend will probably stay there. You guys, folks, look at Kroger and IBM. I'm serious. Those are great sideways trending markets. But we don't always know if those prices are high or low, even in IBM or Kroger, because they could make a big announcement or something like that. But what we do know about options is they give us a tell whether they are expensive or cheap. And it really just comes out to a chart that looks just like the sideways trending chart that we've been looking at. You know, I mean, there's going to be different ebbs and flows, don't get me wrong, but volatility does look like this, where we could draw lines and say, that's kind of the range it's going to want to stay in. So like if this came up in this area, well, then you would know that that was expensive, right? When it gets up to that area. So volatility gives us a tell. Why? Because we know implied volatility. So when I'm talking about volatility, I'm speaking with regards to implied volatility and not the VIX. Well, the VIX does show the broader market's overall volatility coefficient. I want to know what the underlying I'm trading's implied volatility coefficient is, because it's different than the VIX. It's different than, if I'm looking at IBM is going to be different than NVIDIA, because they are different beasts. While they are both technical companies or technology companies, IBM is just a little bit too big and boring to make those kind of volatility moves. There's too much involvement, really. So one thing I want to get out there is when we're talking about the Greeks, all right, and implied volatility is just Vega, all right? Yeah, I'm getting a little ahead of myself right here. But anyway, Vega is implied volatility when you're looking in that option montage, all right? And one of the rules with options is simply that if there is a move, it's expected to be an advancement, okay? So for instance, an advancement in the stock moving $1 higher would affect one Greek. In particular, volatility, implied volatility, Vega, is affected by 1 percentage point increase in that implied volatility. Whatever is associated, that coefficient that's associated to the options, that's how much it's going to go into the premiums on an increase, all right? Now, one thing with the options, think in mind, there's positives and negatives in there. And if you're buying a negative, it's a negative, okay? If you're buying a positive, it's a positive. You sell a negative plus a negative equals a positive, right? So you have to still go through some of that process on your own just to kind of wrap your heads around it. But all of those math rules are going, or algebra rules maybe even, are going to be in effect. So 1 percentage point increase is what we're looking for in implied volatility. Now, listen, it doesn't always just move in 1 point increments. Sometimes it's 10 point increments. So you'd have to multiply it times 10 to get that increase or decrease, if you will. But when volatility starts getting near those top ranges, we know that the pricing over in the option montage is expensive. All right. It's a direct correlation. We can look at it, maybe not as expensive as the pandemic, but that kind of volatility is what we call on the floor a black swan event. It's a rare occasion. Now, that kind of fear is still very fresh in our minds. So do I think that we're going to see that kind of volatility in the near future? No, because that unknown was very scary. People thought they were going to die tomorrow, right? So that kind of volatility is not probably expected for maybe another 10 years or so. So while volatility might be on the rise, I don't think it's going to get back to an extreme where we've seen. So yes, it will break out of those ranges every now and again to the upside and to the downside. But we know where that range is because we know it's going to want to come back down. In a moment, I'm going to show you some real life examples of this and how it shows up. But before I switch the channel, before I switch the page, so what we can see is this is implied volatility, folks. And it doesn't matter if it's ABC or XYZ or Apple. They all have their own implied volatility coefficient. So I've drawn some lines in here. Yes, I let it break out, but I try to capture as many of the tops or bottoms that I can to create that range. I'll let it peel out because I know that this underlying for the last as far back basically as you can go on your charts is going to be well within that range there. And I'm going to show you some examples of that as well. Now think about it. Before the pandemic, that paradigm might have been in that range right here. Post-pandemic, with all the things that we've gone and seen, it may on some be a little bit just a notch higher, if you will. Okay. So you got to keep that in mind as well. But you can see that a lot of times when we shift these lines all the way back in time, they will be within a nice little range there. So here is that same underlying. I did throw a yellow line in there, but you can see as you stretch it out, there's the pierce. But if you stretch it out back through time, we can see that it's always been within that range pretty much. Now, pre-pandemic, well before this underlying did have a slightly lower coefficient, but for the most part, you can see that it's wanting to stay within probably, I'd say 45 to 25, something in that range. At the low end, it would go down to maybe 20 or something. But for the most part, we can see 3 years in the past, well, we were in that range. So what's the expectation going forward? Well, I would still expect it to stay within this range between 45 and maybe 25 for this underlying. And again, folks, it doesn't matter what it is. This is PDQ. I don't know. It doesn't matter, right? Because all we're trying to do is show you examples of how this comes out in real life. Now, here's an example of NVIDIA. Or sorry, no, this is Netflix, but it doesn't really matter. Again, we can see that it has a tendency to break out of that range a little bit, but for the most part, it's staying between, let's say 22 to let's say even 50 maybe on the very high end there. But even pre-pandemic, you can see NVIDIA was staying within that range. Now, I don't always know exactly where it's going to be. I start putting in these lines based on the last 52 weeks because I when I'm doing my charts here, I usually go maybe the last 52 weeks. And most recently, I've kind of shortened that into about 6 months to keep my range as the top and bottom going forward. But again, if I do that and send those lines way back in time, I can see that they're still going to line up. So when we want to take advantage of, it doesn't matter where Netflix is on this one. What we want to find is from this chart is whether or not the premiums over in the options for Netflix are expensive or cheap. I don't even care what Netflix's price is right now. All I'm trying to determine is I'm looking at Netflix. I'm trying to decide, do I want to put a trade on? Volatility I can see is extremely high, right? We can see if volatility is near that high band, which means prices in the option Montage are more expensive. Now, why do I say that? Why do I say that with such conviction, right? Because it's math. If we look at every single month for, let's just stay with Netflix, all right? If we look at Netflix and we're looking at the pricing, it doesn't matter, if it's this year with 45 days to go, or this month with 45 days to go, or next month's option montage with 45 days to go when it rolls in. Those prices, if the volatility was exactly the same and the price was exactly the same the next month on that same day, those prices in the option montage would be the same, because it's a product of volatility. When volatility goes up, those premiums go up, right? And when we have a finite day, we know that there is time decay left in that option. So if 45 days to go in January, 45 days to go in October for that same underlying, that premium for the time coefficient is the same. The only thing that is changing, we left the price the same, exactly the same. Only thing that could be changing to cause those prices to go up and down at that point would be volatility. Because as volatility rises at any given moment, even if the underlying doesn't change price, you guys, those options prices are going to go up. During the financial crisis, even actually as far back as the .com, I knew people that had long calls on that .com crash, and they got out for like sometimes possible profits, but most likely at least a scratch. They weren't losing their butts on the market free falling, buying calls, because the volatility on the call side was even exploding. So while that volatility was increasing and the underlying was dropping, volatility was outpacing the drop of the underlyings in a lot of cases. It doesn't always happen, but we can see that happen quite often, especially if you get involved at the right times. You know, you're buying something when the volatility is super cheap. You can easily see that volatility start to rise during that time, more likely than trying to buy options when the volatility is extremely high. So ultimately, volatility is going to drive price. So if I'm going back to my example of Netflix here, right, we can see the volatility coefficient isn't back 3 years. But what I could do is, I think I started playing around with this a little bit late this afternoon. So I started drawing these lines in here on Netflix, and I hadn't pushed it all the way out. But this is what I usually do. I'll kind of find that range here, and then you can just easily do this, extend it to the left, and extend this one to the left, and then just drop it into a longer duration chart, and you can see, look, it shows up. I could even go to, let's see if I can find a underlying here. The Netflix is there. Let's do something like Kroger. You guys heard me talking about Kroger? Well, I guess I already did the charts on that one. But you can see it draws back. I put that into a weekly chart just to pull it back. Let's see if Nike's got anything on there. I guess let's do this. So same thing, try and draw the chart in there. Where am I going to put it? I'm going to try and hit these, clip a couple of these. So I'm going to go a little bit lower there, try and draw it as close to flat as I can. If I can see it. Am I going higher or lower? Sorry. There we go. It took a lot longer than I thought. All right, let's do this one. See if I can get it in there quicker this time. Come on. Doesn't want to let me do it. I'm going to try and go with that. It's because I don't have the patience right now. Sorry, folks. Let's go draw this out. And you can see that that line is pretty good. This line, I think, is just going to angle, so it's not going to be very good. But we can see still, even pre-pandemic, pretty close to that range. And the last 2 years, definitely been within that range. So, you know, even Nike shows up. I don't even have to pick anything I know. I guess I could have done it without knowing first. But you guys get my drift as to how we can see that even though this may look like, oh, dude, it's never been that high. Well, you draw it back there and you'll see that that is basically where the high of Netflix ends up being. So with that said, we draw in our lines on the chart here, we can see that's a high. We've got our lows. So now we've got our range. And the bottom line is when we're trying to draw in those lines, I wish I had put them in here, but I'm going to try and draw in some lines here. They're not going to be very good, but you got your high and basically you got your low. And then you're going to try and draw it right down the middle to kind of give you a gauge as to whether it's on the upper side, upper band or bottom band. You could even draw in the quarters, but I say that this is the sell zone up here, buy zone. And if you are newer to trading options, then kind of put this, break it into quarters. And then you only wait for that extreme quarter to start trading, right? Because then you are pretty confident that you are entering a trade at those highs. Now, I usually get a little bit more aggressive. I'm just above and below that 50 mark for the most part at any given point. So an easy way to do it, draw in your lines. It's easier to do it with that, but sometimes I don't know if the platform is just going to perform like I want it to right after the close. Sometimes it gets a little jukey with it. And folks, I am trying to keep my eyes over there for the comments. If you guys have anything, don't forget to hit the like button though. That could be your comment. All right. So we're trying to find that range. Now, let's do some little bit of real quick back to basics. Okay. We've talked a little bit about the Greeks, right? Don't run away. One of the things we talked about, it's always an advancement, right? So when we go over to the options page, we're going to see Delta, right? A lot of folks have heard of Delta. It's usually the one that everybody talks about, one of the easiest ones to understand. And it is on one increase of $1, all right? So $1 increase. So for an underlying, that was trading 100. Let me see. I didn't want that to come up. I think I'm going to take that thing off. So if we're looking at XYZ, let's just say XYZ is trading $100. All right. So Delta would be on the first dollar increase. And when we're looking at options, the over in the option montage page, we can see, I'm going to pull this over here. We can see these ones that are pretty much at the money are the ones that are going to be the ones that are around 50. Now, this isn't a very good example, of course, but usually the ones that are very close to at the money are right around 50. You can see these are 195s, right in between the 190s, 195. So those are the ones that are right around that 50 delta, okay? So delta at the money, now the at the money ones are the ones that are trading where the underlying is trading. So if the underlying is trading 200, the at the monies are the 200 calls and puts, all right? Those are the ones that are trading closest to it. Now, there's a little wiggle room. If it's trading 200, the 200s are the at the monies. Some people will say the ones just below and above are also at the money. We're splitting hairs, all right? But those ones that are at the money I talked about are about a 50 delta. And that's because when we buy and sell stocks, your quote unquote probabilities are 50-50 that you have bought a stock that is going to go up. And you've got a 50% chance that you bought a stock that's going to go down. So the same thing goes for the at the money options. They're a 50-50. So Delta tells us a lot of things. But the first thing that everybody learns is Delta on that dollar increase. Now XYZ goes to 101, right? Now Delta goes into the premium. So if we had, let's just say, I'm going to draw it down here. We've got the calls on this side, the puts on this side, and we've got these 100 strikes. Let's just say they're $1 bid at $1.50 on both sides, just to make life easy. $1 bid at $1.50. And that's probably cheap, but $1.50. All right, so on that first dollar increase, the delta on the calls is positive. The delta on the puts is negative. So this would be I'll put the puts up here, a negative 50 delta. All right. So on that first dollar increase, delta goes into the calls. So on that next dollar, we would go to $1.50 at $2, right? Because this 50 cents goes into those premiums. On the flip side, these dollar higher plus a negative means that the negative delta goes in here. So we're at 50 cents and at $1. So when these moved up, these moved down, right? Okay. Now we're talking about gamma. So gamma at the money options usually have about a 5 cent, 10 cent, depending on how big the underlying is, a premium or a coefficient associated to it. Well, the easiest way to remember gamma is gamma goes with delta, all right, on dollar number 2. So now XYZ goes up to 102 and the gamma goes into delta. So then gamma goes into delta, and then on that next dollar move, I'm not going to be able to write it in there because it's taking my pen, but you could see the 55 cents would go in here. So these would be 255 bid at, 205 bid at 255, right? Because 55 cents goes in delta, then gamma goes with delta. So that would be 55 cents this time going in. Okay. So gamma goes with delta. One thing though, we used to say on the floor is delta is data. Now you heard me start talking a little bit about the probabilities. Why delta at the money is 50-50. It's because it's probabilities, right? Well, delta not only tells us the coefficient that is going to affect our premiums, but it also tells us probabilities. A 50 delta has a 50% probability of being 1 penny in the money at expiration. So remember, when we were talking about those calls and puts and the deltas on those at the monies, it tells you, the delta tells you what the probability is of being in the money at expiration by at least a penny. Okay. So it doesn't have to, even the money, deep in the money options, an 84 delta has an 84% probability of being in the money at expiration. Only by 1 penny. Okay. So, but if you can know the probabilities, it will help you keep your powder dry and will help you understand how the levers and pulleys are working in here. All right. The other thing is on the floor, we used to say 2 times delta equals your probability of touch. We used to actually say it was a probability of getting kissed as a joke, but probability of touch is probably more acceptable. So 2 times the probability is the probability, or 2 times delta is probability of touch. So 50 delta, well, it's at the money. You have 100% probability of touch. Why? Because it's probably traded there already. A 16 delta though, a 16 delta option, whether it's a calls or puts, has a 16% probability of being 1 penny in the money at expiration. 2 times the probability, that same 16 delta has a 32% probability of touch. So when you're trading options, folks, know your probabilities of touch, because then you know when you've beaten the probabilities, right? If the underlying goes up there and touches your 16 delta, it's probably time to get out of that trade, especially for a winner. All right. Now, if you have that 16 delta and you're still confident with your trade and it comes up there and hits you right away, well, you can understand that, hey, I'm still in this to win this because I know my probabilities of success are much better than getting beat up by this 2 times the probability. So delta is data. All right. And there's a lot of things that delta tells us that I don't have time to go over. I could probably spend a half an hour on just delta alone, but just know it affects your premiums by the first dollar. It's the probabilities of being 1 penny in the money, and 2 times the delta is your probability of getting smacked. All right. All right. So when you see an option where the 50 delta is 2 or 3 or 4 strikes away from the at the money, does that concern you? That's a great question, Ron. And what you're bringing in mind or bringing up here is called skew. And I haven't talked a lot about skew in the markets, but what it is a product of is when we see folks going in without regard to price, and they just are going for panic in a sense, fear of missing out, FOMO, with calls going to the upside, or fear that the market's going to fall out of bed to the downside. That's why folks are buying calls and puts. Now, they don't look at what I'm trying to make sure you guys understand is this volatility coefficient, because they're buying options sometimes without regard to the price. They're just not thinking clearly. They could be buying the high in volatility, right? But all they're thinking is, I need to pay for these calls, all right? So that can cause skew. So when a fear of missing out to the upside, which is what Ron was talking about, say, for instance, calls to the upside are a 50 delta. Well, that's because people are coming in and rushing and trading these options without regard. So it creates skew. If they're buying puts, a lot of times we'll see that skew happen to the downside because they're driving price up. And as price starts driving up, it creates the probabilities. What we're telling you with that price going higher is the probabilities of a bigger range are more and more likely. So yes, there is a time, or a lot of times, where you will see skew in the pricing. I actually picked one today where there wasn't any skew. And Ron, after seeing your question, I wish I would have picked one that had some skew, because I do talk a lot about that in other videos, and I thought I would probably be beating a dead horse in this one. But please check those out. And it is a product of skew, and it has to do with your bell curves and stuff like that. It gets twisted a little bit. Yes, my dogs know how to open doors. The concern, no, it doesn't really concern me. Actually, I look at it as opportunity, because I know when I start getting massive skew, especially like 4 strikes away, I know it's just ridiculous. What was it? I couldn't, when Bitcoin was blasting off at one point, you couldn't even find a 50 delta option, which means the 50 delta option hadn't been released yet, which is just absolutely mind-boggling that, like, you know, $20,000 higher in Bitcoin, or it was even happening in like GameStop, I think, where you couldn't find like a 10 or even a 25 delta call to sell, because everybody was buying calls and it was skewing that all the way out the curve. So Ron, while I look for that, I don't find it concerning. I actually look for it as opportunity, because I was trying to sell like 800 calls in GameStop. All right. So gamma goes with delta. Yes, there is skew. I will talk about that in other videos, Ron. So please check those out. So delta gamma, the thief. We've got the thief in the night that comes and steals your premiums, right? Really, all this is time, or theta. All right. But think of theta as that thief. All right. He's the thief in the night that comes and steals your premiums. Listen, way out, longer duration options. He doesn't even know you're out there. All right. He's forgotten about you. All his concern is the panic at the disco at the end of the day, where this underlying is going to go off of the board, and he's got to try and capture as much money as he can from you. So theta, while it is eroding your premiums or picking away at your premiums, it starts out as like a little nibble, and then it's kind of a chunk, and then it's a gobble, and then it's just fistfuls. All right, just jamming fistfuls. So it's not linear. It's not binary. It's more of kind of it starts out real slow, and then it picks up, and then it drops off a cliff. All right. So like 7 days, it really, really, really gets aggressive. So like you'll hear folks talk about gamma trading and stuff like that. That's usually trading inside that 9 days. And then right around here is around 35 days to expiration, right? Where you start seeing that kind of blip pickup. I will stretch it out to about as far as 45 days to expiration to enter trades for this, which would be a sell zone, right? If your premiums are going to drop that rapidly, do you want to be buying it in that area? No, I don't care what volatility is. I am not buying inside of 35 days to expiration, because that is an uphill Sisyphean battle that you can't ever make up, really. Yeah, you can, but it's difficult. So what I look for then is 70 days, because that's kind of the sweet spot where you can get relatively decent premiums, cheap, because the thetas come out of it a little bit, rather than like 200 days out where theta is non-existent. Well, if you go basically between, let's say, 100 days to 70 days to expiration, theta doesn't really change that much, and it really doesn't change for the next maybe 10, 15 days. So that's going to be where I'm going to be looking to buy options outside of 70 days to expiration, right? Inside 35 days is where we sell. So the buy zone kind of takes you into this area after you've bought it, and you're not going to get that massive theta decay build up like you would see inside of this 35 days to expiration. So I see a lot of people every single day talking about their option strategies on Twitter and everywhere else in different trading rooms. And they're talking about buying calls and selling or buying puts and stuff like that. And they're always talking about doing it in the front month. And it just absolutely blows my mind that somebody's bragging about their trades that are just absolutely set up unprofessionally, if you will. All right, so sell zone, I suggest getting in this only selling. Yes, you are going to pay a little bit more out here for an option than you would in here, but it's going to decay much slower. So you're being a good steward of your capital. You're holding on to it, all right? If you get inside that sell zone and you're buying, you're beholden yourself to your move. It needs to happen, and it needs to happen right now. So keep that in mind. Outside 70 days, you're buying. Inside 35 days, we want to sell. And then back to Vega, right? We've talked about this a little bit, and this is basically based on the 1 percentage point move. Vega is just implied volatility. It's a fancy name for volatility, all right? So they all just have their fancy names, really, to be quite honest. Theta is just thief. So you don't have to worry about those Greeks. All right, let's get over here to the option montage page. Now that we've gotten a little bit more of a concept. Doesn't look nearly as scary now, does it? Right? So again, we have the calls and we have the puts, right? And then we have our delta, we have our gamma, we have our theta, and we have our vega on both sides. Now, delta on the call side is positive. You can see on the put side is negative. Gamma is always positive. Gamma goes with delta. Think about it. When gamma goes with delta on the puts, the further away you get, it's making your premiums less aggressive, all right? Or makes that delta less aggressive. And then if you start going down, well, gamma goes with delta, but we have a negative plus a negative makes it a positive to our position. And then gamma goes with that. It starts adding into that delta. All right. Hopefully that didn't blow everybody's mind, but that's how it works. Goes down, which is opposite of our rule, the advancement, right? If it goes down, we have to add those negatives. All right. And theta is always negative. Why? Because it's an advancement. Advancement is basically time goes by, right? And we can't stop time. So theta is always negative. And volatility or vega is always positive, right? As volatility increases, all the premiums go up. I don't care where the underlying is going. Underlying stays flat, volatility goes up, those premiums goes up. Underlying stays right here, volatility goes down, those premiums go down. It's just a product of volatility, all right? But back to vega real quick. Back to theta. One thing I want to talk about back to this buy zone, sell zone. We can see what we were talking about here with the theta going in basically, what is this? Probably 20 some odd days or whatever. We do see an increase of about 3%, 3 cents. But then and that's probably a rounding thing, but we go from 30 days to 40 days. That's that next 35 days. How much does these at the monies? Well, you can see theta added another 2 cents. But what happens inside this? Now, that was that extreme area, that 45 days, right? You come in another 30 days from here. Look what theta did. It almost doubled. Almost doubled. Just shy a couple pennies, but it did almost double. So if you're buying inside of this area, you are fighting this uphill battle that I just showed you that chart of. So while, yes, these premiums are more expensive than in here, you're not losing money to theta. You're not just throwing money out the window, really. You're holding on to it. Yeah, you paid a little more, but you are holding on to it. You're retaining it. All right. And then, I don't know what, Vega affects the further duration options more than the near duration options, right? On both the calls and the puts. We can see that. Why is that? Well, I got a pretty good idea what's going to happen in the next 2 weeks, right? At least a better idea. But 3 months from now, 4 months from now, 5, 6, 2 years? No, nobody has that kind of crystal ball. So that's why there's more volatility back there, or a higher volatility coefficient, because as volatility increases and decreases, it's kind of like that multiple on it. All right. So going further out, you can take advantage of volatility there as well. And then what I want to talk about now is this long put butterfly. And the reason why it's considered the long put butterfly is because we are buying, in this case, we're buying an option that is deep in the money right here. We're buying that option and we're selling the 200 option. So we're going to sell that one. All right. So we're buying a deep in the money option, selling an at the money option. Now, this does not make sense in most worlds, including my own, to just do this trade. Okay. But what we can see is that we have to pay a pretty hefty debit for it, right? Over 50% the width of the strikes. We got $25 wide and we're paying $15.33. So that's a pretty hefty chunk of money. So then what you want to do is sell. You're going to go in and then sell another put spread, or sell a put spread. We bought a put spread. Now we sell a put spread to finance it in a sense. Okay. So it is a defined risk strategy, but while it is considered a long put butterfly, we want theta and we want volatility to come out. Does that make sense? We're paying a debit. It's a defined risk strategy. The only amount you can lose is your debit. But the reason why is in the money options have a benefit. Like there's a benefit to owning an in the money option, meaning I can sell by buying this this 225 put right here. That gives me the opportunity to sell Netflix at 225 when it's trading 200. That's a pretty good benefit. $25 higher, right? Nobody in their right mind is going to give you that option for less than what it's worth, right? Less than that benefit. So you're at least getting this $25 option, and we're trading 201, 202. So let's call it 202. This in the money option has a benefit. If it's trading 202, it has to be worth $23 at expiration. Remember, theta is still in here. We still have, 30 some days to go. So there's still theta in all of these options. Time decay is what theta is. There's still time left. So there's still premium in there. Well, a real easy way, a trader hack, is look over at the corresponding options that are out of the money. And that pretty much tells you what the extrinsic value or the theta is of this underlying theta and all the extrinsic theta, vega, and all that. The benefit is just what the value of that option is worth. So while this one has a benefit that in the money options, this option here that I'm buying, the 175s, does it have a benefit? Is there any benefit to selling Netflix at 175 when it's trading 200? No. There's opportunity, yes, but that comes with a price, and that's theta. You have to buy your time to be right when you're in those out of the money options. You have to buy your time to be right anywhere, but more so, you have to buy your time to be right further out in options, which is why they're more expensive further in time. For the more time you want to be right, the more you got to pay for that opportunity. Okay. So theta is going to erode away to zero on anything that's out of the money, or actually on anything in general. So then in the money options, we'll just be left with their benefit, what the value of that option is versus where the underlying is. And all of the out of monies are going to just expire worthless. So the idea here is to buy this in the money option with a little theta decay. We get that there's some theta decay there. We're buying this one. We know that there's some theta there, but we're selling two at the monies. Now, an at the money 200 put, is there any benefit to owning a 200 put? Not if I'm looking up here. Well, not really, right? I'm buying a put. I would be selling the underlying below where it's trading. So there's no benefit in that. So if I let this whole thing kind of work itself out, theta Vega comes out. The reason why I want this with Vega is because those at the money options are going to be chocked full of premium. You can see the at the money options have the highest Vega coefficient compared to the out of the money options. So if volatility starts coming down, which options are going to be affected the most and the quickest? The at the monies. Those are going to decay quicker from the volatility dropping than those ones that are further out or in the money, all right, or further away, I should say. So when volatility starts coming in, if it starts coming in really quickly, we could see if this came down, let's say 10 cents, right? These options would decrease, or 10 percentage points. These options would decrease by basically, those two would decrease by, what is that, $5, basically almost $10, or $50, well, $5, yeah, basically, I was trying to do the option contract multiplier, and I thought about pitching that out there right now, but I don't want to confuse anybody. So basically, these would go down by, if this went down by 10 percentage points, these would go down by $2.50. These would go down by $2.60, right? Because it's a multiple of 10. These would decrease by $1.50. These decrease by $2.10. So you add the longs, the long puts, we're looking at $3.60 decrease versus a $5.10 decrease, right? So those ones at the money are going to decrease quicker, right? So let's flip it over to the other side. If this is the other side of it, we got the sell the call. We got the sell the call here, buy the call there, right? So this is the option we're selling for a credit. So we collect a credit. That helps us pay off some of that debit we paid, right? We know it's not going to pay all of it off, but it will help. So we're selling this option to finance the other one because we think this underlying is going to probably stay pretty tight range. I guess I probably should have gone over that maybe a little bit. Let me see if I can find that chart real quick. So this is the chart I was talking about. Oops, where'd it go? Chart. The reason why I want to sell this long put butterfly is the same reason I did it for last month. Last week's did pretty well so far. It's up $1 already on that trade. It's still within my parameters of trying to risk one to make two here. So I decided to look at it for the puts as well. So I'm looking for Netflix to trend sideways. I don't think anything's going to happen because their earnings are still quite a ways away. I'm going to be outside of that with this trade. So I'll be able to take advantage of it stuck on this point of control where most time and volume has been spent. It's going to kind of settle down there. Volatility should start coming out and help me out. Also, theta, I don't think it's going to go anywhere. And that theta is going to affect those at the money options more as well. So all of those levers and pulleys at that with this strategy should start working in my favor there going forward. So let's go back to this trade on the Analyze tab. This is that same trade for the debit. You can see if the market goes down, got a long put spread, it's going to go up in value. Now we can see that the long put spread is worth $25 at the end of the day. If I got the full width of this spread, $25 wide, that's how much I can make on every one lot. I paid $15.33. So my max profit on this is really only $9.67, which, as you can see, the upside. So definitely risking more than we're able to make when you set it up this way. But then if we were to throw in the other side of the trade with the short, then we get this flip in the paradigm where all of a sudden the peak jacks up to where we're risking risking basically $7, let's call it $7 or $8. And you can see the max profit here is about 1,600. So I'm risking 800 to make 16. So risking 1 to make 2. So by selling this strategy, we are able to increase our profit, but we did increase our risk, right? Anytime you increase your risk, you should increase your profit, and those things should go hand in hand. Decrease your risk, decrease your probability of profit, all right? Here, we've just increased our profit and slightly increased our risk. Why? Because in the other one, in the original, if we just went down, that's when we made money. So now we can't go down, we can't go up. We've got to stay right here. We got to pick the number. So we're looking for 200 for that, picking the number. This is the way you build it out properly. And one thing I want to talk about real quick, that's just layering those together. Here's what I want to talk about though. Now that you understand the levers and pulleys of how this works, right? We're selling a call spread to finance that long put spread to try and nail this number. But really, how do you pick those strikes, right? You saw me picking $25 wide. How did I just pull that out of the hat, right? Well, it's basically 2 times the credit of the at the money options that we're looking at. So we're looking at this option, and you can see you sell 2 of those. You're selling the at the monies for this strategy. Some folks will teach you this a little bit differently, but I'll tell you, there's not really a reason to do it. It's a low probability strategy, especially when you're trying to pick, out of the monies on this, or, wherever else. I don't know if anybody would do in the monies. I doubt it, but I've seen people put this strategy on an out of the money, all out of the money strikes. Well, the probabilities of you nailing that number is very unlikely. Right, nailing the number that far out in time at a higher price or a lower price, you think it's going to rally up and tag that number? It might be. You might be smarter than me, or you probably are smarter than me, but picking a number is very difficult, and I've rarely seen people be able to do that consistently. But when we see something like Netflix, where it's trending sideways and earnings is coming up a little bit out of the way, but no foreseeable news about Netflix coming out, that would really make this move. So that's why I want to try and nail it down right here around the 200 level. So if I look at that premium, I can see that 2 times that is right close to $23. So I stretched it out to 25. So, last week we were talking about, I think it was $27, and I went to 25. So you're trying to get as close to that as you can. You could bring it into the $20 if you wanted. I wanted to stay consistent with this because I did the calls last week too. But that's kind of your ballpark. All right. 2 times that credit I've got because I've sold 2 of them, right? That I'm going to go out $25. Then that's when I start to look to define that risk by buying the 175s and buying the 225s to define that risk. So while I started this strategy out earlier on, showing you how the levers and pulleys make this work, the easiest way to do is go inside of 45 days to expiration, or better yet, 35 days to expiration with high volatility, because we know those premiums are super expensive. That's when we want to collect a credit. take advantage of that volatility coming out and the theta decay that we see getting ready to ramp up for us. So all of those things were going to affect these at the money options that I want to decay. You can see the theta, the vega, all of that stuff is going to impact those ones at the money more so than the ones that are out of the money where I bought them. So am I being a good steward of my capital? Yes, I'm buying the ones that are going to decay more slowly than the at the monies that I expect to rapidly decay, right? Now, when I've been mentioning rapidly, and it's a bit of a misnomer with this strategy. This strategy is a bit of a drawn out strategy where you gotta be in this strategy probably for a couple of weeks. Whereas, you sell calls or sell put spreads based on a directional move. You can see that theta or those levers and pulleys work in your favor a little bit quicker. We've got a lot of counterimposing factors going on here. You really want to have volatility crater right away for this strategy to work out quick. All right. But usually it takes a little bit more time to work out and make a profit with this strategy, or to see yourself really get profitable. It doesn't happen quickly. It's a bit of a longer process, I guess. And again, when we build it out normal, we can see that the strategy comes out just like that. All right. Does anybody have any other questions? Let's do a little quick review. I'm going to pull up the platform because it seems like it's working. I was a little afraid it wasn't going to work. But again, what I'm looking to do, the market has fallen out of bed since I did that strategy. We can probably check it out to see where it's at. But ultimately, if I were coming in right now, I would be looking at these. As a matter of fact, if Ron's still around, Ron, look at this. We've got one of your little paradigms here where it's kind of close, but we would expect that this be about a 52 delta, right? Because it's right in between these. It should be somewhere between that 50 there. And here we can see that the puts, or the calls on the other side for the 195s, a 51 delta is a tick further and up and out of the way. The reason why this is happening is because folks are skewing Netflix by buying calls, all right? They're rushing in here buying calls because, they love Netflix and they want it to go up. So they're skewing the call side a little bit. Does that make sense, Ron? They're buying these calls more than they're buying these puts. Now, while volatility does increase all options across the board, if you're buying up those options in the front month, it will create that skew, all right? Kind of drives it if it's not evenly bought. All right. I don't know what happened there. Done the wrong thing. So again, we would want to sell, if you're just building this out today, you'd want to sell 2 of those. Hold it down. I don't remember how to order entry. That's what I want. After the close, it tries to set you up the other way. So sold 2 of those. That means that I got to double that. So $23, let's call it, because I've sold 2 of them. Then go in, buy the one. Just make sure. Oh, it's skewed off. Let's do this. I jumped a little early. So I did 25 down. So I did 2 of those, right? So 25 down is going to give me the 65s, and the upside, the 15s. So very close to what we were looking at there earlier with this strategy. But that's how I start to build it out. Again, we can see the theta further out in time. You start clicking on these, you can see theta is not very much, maybe increased a little bit, but the real ones that we normally would trade, some folks will go out as far as 150 days, right? 90 days is really about as far as I go out normally. But you can see the theta from 9 cents to 12 cents increased about 3 cents. Then the next, 25 days, we go from 12 cents to 15 cents, so another 3 cents. So you can see, way out there, yeah, it is still 3 cents. It's still eating away at you, 3 cents at a crack. But then you go from 71 to 36, this is where I started saying that starts really starting to bend over. Well, we can see 15 to there. We got 4 cents. It increased an extra penny. All right. So that's why I'm looking at these outside of 70 days, because even out here, yeah, the next 20 some days, I lost 3 cents. Well, these next 20 some days, I lose 4 cents, but I'm paying a lot less for those premiums by $5. Right. So while theta isn't really getting aggressive here, that's why I like to pick this, because, you know, while it is less aggressive out here in time, I don't plan on being in this strategy for that long, and kind of gives you a little bit of the best of both worlds. You're not paying through the nose for these options, but you also aren't getting ripped off by theta every single day. All right. So we can see that happen over on the puts as well. Does not increase very much as we're going through 3 cents to 4 cents. And then we go in to here and we can see basically it's doubled during this time. So you don't want to be buying options inside of 45 days to expiration. If you guys don't take anything away from this entire video other than that, then I've done my job, right? And you guys can take advantage of this. I'll throw the link over there. Maybe I won't. I must have copied something else and it's not wanting to paste for me. I'll get it in there for you. But anyway, this is the link. This gives you guys all kinds of videos. It will actually give you this page here. It'll bring you to that page. And when you're doing these videos, you're going to be able to click on a video, watch that video, and then you're going to be able to go and if you watch it halfway through, it'll tell you watched it halfway through. So you'll easily be able to see when the prices or which ones you've watched and which ones you haven't watched. So while I'm messing everything up over here on my charts, trying to figure this whole thing out on the fly to get you guys this link. I will get it there before everybody leaves. There you go, folks. Should be coming across right now. I appreciate you all. Like I said, that's the link for 36 bucks. I probably saved you 36 bucks if you just don't buy calls inside of 35 days or puts inside of 35 days. But this is everything you get. How to protect your portfolio using options. Not only that, protecting your portfolio against rising interest rates. Anybody concerned about rising interest rates right now? What it's going to do to your portfolio, not just even your house price, but what it'll do to your portfolio. I'll go into detail in these videos as to how you can counteract these negative moves, because we know that with interest rates, I'm not going to give me a pen. Interest rates, as they go up, they're inversely correlated to price. So when we're talking about interest rates right now, and they are expected to rise, right? So then it goes like that. Well, what is the counter side of that? Price drops. So your portfolio is based on the price of the bond, and as price of at that, $5 interest rate bond sees interest rates go higher, well, the value of that goes down. Now, if you hold it to expiration, 30 some days, then yeah, you'll get back par value. But most people hold bonds, no matter what duration, for on average about 7 years. So you can't chase yield. You can't just get out of those bonds and be like, hey, you call up your financial advisor, I need more GMOs at 6% or whatever. It doesn't work that way. You've already lost the money on your bond. You can't chase that yield to make up for it. It just doesn't work that way. The only way to do it, if you got those bonds in your portfolio, is lower overall cost basis on it until you can get out. And that wraps it up, folks. I want to say thank you guys all for joining me today. I don't know why it doesn't want to stay on that thank you page, but take advantage of this, guys, because this is the course for $36. Usually we're having to pay a little bit more, but we'll also talk about when, where, and why we're trading options, why you want to get involved. All right. So please check that out. Don't forget to subscribe so you can catch the ones where I'm coming in unannounced. I just sometimes pop in, start talking about the markets. If you want to be a part of those, then make sure you guys are hitting that little bell next to the subscribe button over on Facebook. We're live as well, so you can also watch us there. And I appreciate all the kind words. Thank you, John. Thank you, Ron. Take care and have a good weekend. If I don't talk to you, I'll see you tomorrow in the spot to trade, but can't take that. Take it easy. I almost lost my light there.